Record on this computer. Okay, here we go. So the idea of the tax later never is tax now later never. It's just to put them on is to get a framework of thinking. There's a reason why we have three options, not just because that's the ones that exist, but also because we're going to ask them to make a choice. And it's easier to make choices when you have less options. This idea that you can make better choices when you have unlimited options is scientifically not true. There's a lot of studies about this. People get confused. They can't make a decision. They have no way to evaluate and compare, and it's hard to do. So the idea of the tax now or never is to conceptualize everything from a tax diversification perspective. So this is kind of the way I get that started. So Mr. Klein, when you're thinking about saving money long term, you're going to have three major enemies. Number one is taxation. Right? We're going to talk quite a bit about that today. And it's an enemy because every time you have to pay money, it's money that is not working for you. And one of the most expensive areas of your life is going to be the amount of taxes that you pay. The second enemy that you're going to face when you save money long term is going to be inflation, which is the silent killer, right? It's happening on the side. We don't see it, we don't feel it, but it's there. And every year, it's making your money less valuable. So the idea here is that at least we grow beyond the rate of inflation, so our purchasing capacity stays there and we don't lose it, okay? And of course, you can give examples of this if you want as you're going, depending on the client. There's no, this is not the way, this is the only way to do it, right? So you want to create conversation as you go through these things. And number three is going to be procrastination, which means that people know they have to do something, but they never get around that, right? And you, Mr. Klein, you're not the one to procrastinate, are you? No, of course not. The reason why I put procrastination there is not only because it's true, but also because I'm priming them making a decision. If you're not a procrastinator, that means you're going to do something, right? And he's going to go like, yes, okay, fantastic. So I'm pre-closing. I'm getting little yeses. All right. So when it comes to taxes, when it comes to the way that we pay taxes, and as we are saving money long term, you really only have three options. We have vehicles or financial instruments that are taxed now. We have vehicles that are taxed later, and then have vehicles that are tax exempt or tax net. Okay. So what does that mean? So let me start here with tax now. So Mr. Klein, who do you bank with? And they may say, oh, BofA or Wells Fargo, whatever. Okay, fantastic. So I'm sure you have a checking account and you may have a savings account. And so, yeah, okay. Do you know how much interest are you making on your checking and savings account? Most of the time they're gonna say, no, I don't know. Okay, well, let's say you're making 1%, which is about 10 times what you're actually making, but let's just do a round number. And they kind of laugh when I say that. Okay. And let's say we get to the point where you have 10, 15, $20,000 in your savings account, and you go down to the bank and say, Mr. Bank, I have this money in my savings account. What should I do with it? Most of the time, they're gonna offer you something called a CD, a certificate of deposit. And right now, you can get a 5-year CD anywhere between 1 and 1.5%, right? And they say, yeah, okay. So what tax now means is that every year you make interest, you're gonna get a 1099 because you are supposed to pay what is called a capital gain on that money. So if you have $1 million, you make 1%, which is $10,000. You're gonna get a 1099 or 10,000 because the government wants 20 to 25% tax on that. You gotta pay that capital gain. Obviously, inflation is going to be a factor because 1% we're growing below the rate of inflation naturally, so your money is actually going backwards. So now you got to pay tax on actually your money going backwards. You see how that kind of sucks? And they go like, eh, that's terrible, right? Exactly. So your money, make these lines longer. So your money, instead of kind of like compounding like this the way it should, ended up looking more like this. Why? Because instead of reinvesting those earnings, we got to share those with the IRS. So when you look at stocks or brokerage accounts, they all function the same way. Every time you make a gain, you got to pay tax on that gain. Does that make sense? Yes. Okay. Awesome. So now let's talk about tax later here. So what's tax later? Or what they call tax deferred. That's the other number that you're going to hear these be spoken about. So the IRS understands this problem. So in their infinite wisdom, they came up with this idea of tax later. So here's where your 401k, your IRA, your 457, your 403b, your SEP, your Simple, your Keogh. There's like 25 of these things out there. And 401, 403, all those are IRC codes. You know, you go to the IRC code, 401, section 401, section K. That's where you find everything that governs qualified plans with regards to 401k. That's what those are. Okay. Now, something that I like to always remind you, all of you as agents, and I like to remind the clients, is that 401k plans were never meant to be retirement plans. They were never designed to be such. They ended up being that by default. So we'll use a different meeting, Mr. Klein, to talk about the history of qualified plans. But I wanted to remember that they were never meant to be retirement plans. Before 1979, you couldn't buy a 401k plan. It didn't exist, right? So what's the benefit of 401k plans? Why have they become so popular? Well, the reason is every time you put dollars into this plan, you get a tax benefit. You get what is called a tax deduction, right? That means that your income or your liability when it comes to taxes in that particular year goes down. So actually your paycheck is gonna look a little bigger. And we all like that, don't we? And they go like, yeah, exactly. So that's almost people like it. Also, the second benefit you're gonna get is that account is gonna grow tax deferred. Meaning that every year you make money, if you make money in the account, and as the account grows, there's no capital gain to be paid. So that's good, doesn't it? So yeah, that's pretty good. There you go. However, there's a catch. And the catch is that when the money comes out, now you gotta pay the tax. What kind of tax? You gotta pay income tax. So the logical following question will be, okay, so how much is that? And the answer is, I have no idea. I don't know. Because the tax on that money is not based on the tax bracket when the money went in, or your tax bracket when the money went in. The tax on that is based on your tax bracket when the money comes out. So if you make the mistake of being successful in your working lifetime, you may actually have to pay more in taxes than what you're paying, than what you're deducting today. And that wasn't the case in the 80s, right? Because, you know, grandpa was paying this much and now he's paying this much. And I encourage you, by the way, guys, to use your arms and your hands because that moves them. That moves their body. If you use their hands, they're going to move their eyesight. And that's a good closing technique, right? But now you and I might be on this environment, right? And here you can use any example you want to. Just because I'm lame, I like to use the Beatles, and because I'm a nerd and I like the Beatles. But you can use any example that you want to. And that's when I tell people, hey, have you heard of that song, Taxman? Say, oh yeah, it's a Beatles song. Yeah, 1966, Revolver, one of the best albums ever made. And then we talk about Revolver, right? Well, the reason why George Harrison wrote that song is because the Beatles back then, they were paying 95% in taxes of every pound they earn. Sounds like a lot, doesn't it? 95%. And you know why they moved to New York? They moved to New York City so they could pay 92%. Because most people don't realize that in the 40s, 50s, and 60s, your largest marginal tax bracket was 90%. Because, you know, we had to pay for the war and all that kind of stuff. And then in the 70s, went down to 70%. And then in the 80s, went down another bunch to about 65, all the way. Mr. Klein, do you know what the marginal tax rate is right now? The largest one. They usually say, I don't know. What is 35%? So let me ask you a question. we're in a situation we have the largest national deficit in history. Our deficit right now has become, since 2 months ago, larger than the one we had at the end of World War II, which is the reason why we had those taxes, because we gotta pay for that, right? So right now we have the largest deficit in history, and we have the lowest tax environment we've ever had. So if you were an investor or you were a money manager, what would you say? Do you think tax rates in the future will be better than they are today? That means lower, or do you think they're gonna be higher? So again, we have the largest tax deficit in history, and we are in the lowest tax environment we've ever been. So what do you think? Taxes are gonna go up in the future or go down? And 99.9% they say they're gonna go up, right? Which is what you wanted to say, because that's what I believe is gonna happen. No, say this is gonna go up. So here comes the $1 million question, Mr. Klein. If you're putting money in a place where you know your taxes are gonna go up, does that make sense? Parentheses. This is important for you guys. You never tell somebody what you think the answer is. You ask them, because if they say it, they own it. If you said it, they're gonna argue with you about it. So if the client says, you know what, yeah, that kind of makes sense. So I'm deducting at 20 to pay 40. Yeah, that doesn't make sense. I agree with you, Mr. Klein. Now, if they say, well, hold on, I mean, that's not the whole picture. Okay, then we can talk about it. But you want to get some sort of answer. You want to know where they stand. Because if you know where they stand, now you know where to take them. Right? So if they agree with you, okay, so taxes are going to go up. So that's a problem, right? That means that the more money you have in there, potentially the higher tax bracket you're going to be. Now, I have a little bit of bad news for you, Mr. Klein. He's going to say, what do you mean? What are we talking about? Well, taxes, they are already set up to go up in 2027. You remember the tax law we passed at the end of 2017? Do you remember? You know, like, yeah, the Trump tax cut or whatever. Well, you may not know this, and again, this is not political. It's just the facts, right? That the corporate tax cut was permanent, but the individual tax cut was temporary. So that 35 is already scheduled to go to 37.5. So every single bracket is going to go about 2 or 3% after 2026. So in other words, you have to pay back the tax cut that you got. And they're like, okay. So again, every person's going to be different, but potentially that's what we expect, right? So, and then on top of that, there's a couple of other things that we have found that may not be in your best interest. For example, if you need your money, you gotta pay a 10% penalty. So there's no liquidity there. So if you're young, you're your 30s and your 40s, and you're gonna need this money later, well, too bad for you. The money, if you want to access it, is very expensive money. Oh, but my company told me that I can get a loan, and it's true. First home buyer, educational costs, and financial distress. And by the way, when I say financial distress, that means you have less than $2,000 in your bank account, you have a car, you have a house, and you have nothing else. You gotta be about to be on the street for you to use a financial distress idea to get money in your 401k plan. So remember that. And again, a first home buyer and college expenses, your personal expenses, not your kids or your family, right? So you have almost no liquidity there. And lastly, what most people haven't heard of is the 72-year-old RMD rule. What that means is that when you get into your 70s, they're gonna force you to take the money out, even if you don't need it. Why? Because they need their money back. They want their taxes. And they go like, okay, well, that kind of sucks. So yeah, can be. So now let's talk about tax exempt. So the way I define tax exempt or tax free, it has to have 3 components. It has to provide a no capital gain environment. Also, I want no federal, state, or income tax, and also no state tax, as in California income tax. So for me to have an asset that is truly tax-free or tax-exempt, it has to be free of capital gains, no federal income tax, and no state income tax. And there's only 2 vehicles that actually fit in that category. So here you have your Roth IRA and what I like to call investment grade life insurance. And usually that's when they go like, what? And you know, the eyes start rolling like whatever. So yep, your Roth IRA or investment grade life insurance. So how does that work? Well, when the money comes in, Mr. Klein, you don't get a tax deduction. You pay your actual taxes today, right? Now that may or may not make sense, but you know, if you had a choice between paying tax on the seed or a tax on the harvest, what would you choose? Would you like to pay tax on the small amount or in the big amount? And they usually say, well, obviously in the small amount. And so that may not be a big deal. Now the money is going to grow tax deferred. There's no capital gains to pay when you make interest and as your money grows. But here's a $1 million value of this. When the money comes out, there's no income tax to be paid. So you pay your tax and you're done with it. So you see, Mr. Klein, I'm not against paying income taxes. I'm happy to contribute. I like big freeways. I like beautiful parks. I'm happy to pay for taxes. But what I don't want is have to pay my taxes twice. I want to pay one time, paying what's fair, and we're done. And that's what this will provide. Another additional benefit to this is that you have access to your money throughout the years. So you have liquidity. You have access, use and control of your money to do whatever you want to do with it. Also, your account can be used as collateral. And we'll talk about how that works later. And it's a very cool financial concept that I teach people. And lastly, there is no 72 RMD rules. So I don't have to take the money out. Nobody's telling me what I can or cannot do with my money. It is my money. And that's what I want to do. So when it comes to tax diversification, Mr. Klein, when it comes to tax planning, my ultimate goal here is that when you retire, you never have to submit a tax return ever again. Never. Meaning that in all your money in this bucket, you pay no tax. Of all the money in your bucket here, you pay no tax. And also in all the money here, you pay no tax. You can have a super high millions of dollars net worth. It doesn't matter. I don't want you to pay any more taxes. Do you think that's possible? And they're going to go like, I don't know. I never heard of that before. Okay. Well, let me give you the secret. If I never see you again, if today is our last meeting, I hope it's not the case, but if today is our last meeting, I want to give you the secret. Is that okay? And they kind of like laugh. Yeah. Okay. Yeah, sure. Okay. But you got to promise that you're going to use it. If you're not going to use it, I'm not going to give you the secret. And then they laugh and look at you weird, right? Say, okay, well, here's the secret. The secret stands in the word income. What that means is that the IRS has a legal definition of what income means. Not every source of money coming to you is legally defined as income. So any source of money that the IRS defines as income is therefore subject to income taxes because that's how it's legally defined. So ultimately, my goal here, what I'm conveying to you is that when you retire, or even sooner if at all possible, is when you retire, I want you to have no income at all. But I want you to have a ton of cash flow. And that's the word that I use. That's what I make the distinction. I want you to have sources of income that are not defined as income by the IRS and therefore making it not subject to income taxes. Therefore, you don't have to put it in your return. Does that make sense, Mr. Klein? Yeah. Oh, yeah, that makes sense. Okay. So I'm going to ask a silly question now, but if you have a choice between paying a tremendous amount of taxes or just paying what is fair and never had to pay it again, if you had to choose between those two, which one will you choose? Are they going to go like, duh, obviously just pay as little as possible and not have to pay it again? Fantastic. I like the way you think. Now, that may sound like a silly question to you, but it's not. The reason why I ask that is because I want them to physically move their mouth and say that they agree with me. I don't want them to just assume that they do. I want them to agree with me because if they say it, If they say it subconsciously, they're agreeing that it's something that they should do. So I'm increasing my chances of making that sale or making that transaction. You want to ask those questions, even though you may know the answer of, which is the best questions to ask, by the way. But you want to ask them because that puts them in a position where they have to agree with you. And the more I agree with you, the more it's going to lead to the big yes, right? So usually, I stop right here. Questions, comments on this?
No.
No? So some of you have seen me done this before, so I know for some of you it's not news, but I wanted to do it because I don't know how Bob did it. I didn't see that part. And this might be one of my most important presentations that I use when talking to clients.
Bob didn't really go into details on this.
What was that?
He didn't really go into details on this. He just, he sent us something this morning about it.
Okay. Well, yeah, that's why I wanted to myself going over the details, because
Right.
this is how you do it. And it's taking me a little longer because I'm talking and giving you feedback, but you can do this in a napkin and it can take you no more than 10 minutes. Right? So let's say I'm just meeting somebody. It's the first time I meet them and say, give me 10 minutes of your time. I want to show you an idea. I need you to know what you think. Sure. And I show them this. The question then will be, okay, how can I move that forward? So when I ask them, if you had a choice between A or B, paying a ton in taxes or just paying what is due and no more than that, which would you choose? And they say, sure, yeah, I would like to pay what I owe and nothing else. Okay, fantastic. Well, if you're open to it, I'm happy to look at what you have and give you some ideas of how to reduce, defer, delay, or maybe even eliminate some of those liabilities that you have in your financial accounts or in your net worth. Will that be okay with you? Will you open to that? And that will lead to me booking a next appointment with them to actually review their accounts, what they have, and how to help them make this transition. So that will lead to a fact finder. That's kind of what I'm going with that. Okay. Now let me hold on. Let me grab the material. We have a piece that supports everything I said. Well, I mean, not everything I said, but the majority of the things that I said. So you go your Ohio National login, and the phone number is 2410. Diversify your retirement plan with life insurance. Yay. Oh, this is a new one. Okay. Okay. So they use a pottery wheel example, and I'm not too excited about an analogy. But they talk about tax diversification. They don't use tax now, later, never. They use 1099 now, 1099 later, 1099 never. But it's the same thing. Okay. So they explain what a 1099 is. And then they go into now, later, never. And if you want, you can even use this as an exercise, like a fun thing with your clients. Like, where do you think money market accounts go? Do you think they go in this box, or that box? So if you want to make it like a fun exercise, you can ask the client to locate where all these different accounts go, and then you come to the conclusion that in the tax never, you only have life insurance and Roth IRAs. And I guess you can say Roth 401ks, and they're pretty much the same as a Roth IRA. The debate comes when we talk about muni bonds. Muni bonds, technically, most people put them in the tax never bucket. But the reason why I'm hesitant about those is not only because you get very low growth, but also because they're tax exempt only in certain states and only certain kind of municipal bonds. So you really gotta be careful which ones you're buying. But I guess you can say they kind of go here, even though they don't, in my view, they don't really belong there. For me, they're still taxed later. But let's not get into that debate. So you can kind of like play that game if you want with your client. They can put stuff in there. And then this goes into the cash value life insurance solution. So here you see a summary of what I just said. After tax money comes in, cash value gross tax deferred. You can access your money on a tax-free basis. No limits based on income. That means that you can have as many as you want and put as much as you want. Question for the group: how much can you put into a Roth IRA every year?
6,000.
6,000. And what is the maximum income that you can have and that you can open an IRA, a Roth IRA?
100 and was it 125?
125, 127. To think about that. And that's what I will tell Mr. Klein. Why will the IRS limit your ability to earn and save money on a tax-free basis? If it's so good, why would they limit it? Or if it's so bad, why would they limit it? Again, I'm not conspiracy theory, Mr. Klein, but I will say the reason why they limit it is because they want to tax you. Wouldn't you think? And they were like, yeah, of course. Yeah, they want to limit that benefit because they want you to put that money in your IRA. So you can put $6,000 in your Roth IRA, but you can put $18,500. I think this year's $19,000 a year in your 401k. Why do you think the difference is? So, well, because they want to tax me. At this point, they're getting the logic of it and say, yeah, for every dollar you earn, for every time you double your money, the IRS twice as that as far as how much tax they're going to get. I don't know if I said that correctly, but for every times 100 you make, the tax for them goes times 200. 200%. It's just the way the plan works, and I'm going to show you that in a second. Okay. So no 10% penalty, so you can access to your money, no R&Ds, and also depending on your state, not in California, the account is protected from creditors. So you can use as a list to say, okay, why do we want to put money in the tax exempt level? Well, we have 1, 2, 3, 4, 5, 6, 7, 8 good reasons as to why this makes sense. Okay. And then this can lead to the volatility buffer, which is not discussed here, but that can lead that into making another point or be your own banker if you're doing that. You can take, the cool thing about this presentation is that once you understand that basic principle of how taxes work, then you can take that conversation in whichever way you want to go. Okay. Now, this form right here, this picture right here has made me so much money. You guys have no idea. I've closed so many deals just with this picture. Okay. So hear me out. So once I'm done with my scribbles, usually I go right into this. Usually, right? This is what I'm going to close. So let me give you an example, Mr. Klein, of what I'm talking about. Let's say that we have two people. One person is going to just do what everybody else does and put money in their 401k. That's all they're going to do. Let's use a 401k because it's by far the most popular vehicle in America when it comes to saving long term. And let's say the second person talked to me and says, Janko, you're right. I'm going to put 50% of my money in my 401k and 50% in that tax exempt bucket you talk about. So one person will say, no, Janko, you're crazy. The other person will say, no, I'm going to listen to you. I'm going to do half and half. Okay? And the client goes, okay. So if you have no volatility buffer, no tax exempt bucket, and let's say you retire and you take $100,000 from your retirement plan. You see how here it says IRA distributions? So what happens is that when you retire, you're going to take that 401k and you're going to roll it out. You don't want to leave that money with your company. So that money is going to go into an IRA. And an IRA stands for?
Individual retirement.
Let me hear it. There you go.
Individual retirement.
Retirement account, right? So don't leave it with your company. You are supposed to roll it over. So now you roll it over, okay? And it's in an IRA. So you see, all these are definitions of income. So capital gains. Look at that. Social Security. Is Social Security taxable? Yes, it is if you are too successful. We'll talk about that in a second. So I'm going to show them that all these different things are considered to be income. So because you're taking money from an IRA, look at that. For the taxable amount, 100,000. So this goes down, right? Now, you do get one benefit right now called your standard deduction. Before 2017, we used to have an exemption and a deduction. but we don't have that anymore. Now, every single person, you get an standard deduction of $12,000. What that means is that the first $12,000 you earn in America today are not subject to income taxes. So if you leave off $12,000 a year, you don't have to submit a return, okay? Now, because the first $12,200 you earn are not taxable, we deduct these from the $100,000, and that means that the $87,000 left over, that will be subject to income tax. Just to make it easy, not to get into the calculation, that means that your tax is to pay is $15,253. That means that you only get to spend $84,000 for your money. This is very important because what I want you to understand, Mr. Klein, that it's not about the number. It's not about how much money you have. In fact, that's kind of irrelevant when it comes to retirement. What it matters is how much that you get to spend. That's what matters. See, and you guys have heard me say this many, many times. When you go to Costco, when you go to Ross, they don't take rates of return. They don't take your balance. Last time I checked, they take US dollars. So what matters is not how much you have, but how much that converts to actual dollars that you can spend. That is what matters. So the number that matters here is not the 100,000, is the 84. Is that clear? And they go like, yeah. All right. So now let's see this other person. This other person is going to take $50,000 from their retirement account and $50,000 from the tax never or tax exempt account. Okay. They go like, yeah. So because this other bucket is tax exempt, we don't have to put it here. Now, Mr. Klein, do you find anything in here that says Roth IRA or life insurance? And they go like, no. Okay, therefore, money coming from your Roth IRA is not income, is it? No. Or money coming from the life insurance policy is also not income. So therefore, we don't have to put it in there. It's not subject to taxes. So we're gonna take the same 50,000 now. We're gonna go down here. We get the same deduction, the same standard deduction. So now what's taxable is only $37,000. That means that what we have to pay in taxes is $4,345. So you actually get to spend $95,655. This is going to be a really dumb question, Mr. Klein, but if you had a choice between earning and spending $84,000 versus $95,000, which one would you prefer? Well, duh, $95,000, right? Well, there you go. So why are we doing the opposite? And this very simple illustration has helped me close a lot of business. So much so, because most people have seen this form. This is your 1040. If you've ever done your tax return, you know what this is, right? And you've seen this. So now for them, it starts to dawn on them that when they actually make the calculations, they may actually run into problems because they never made the math. They never done it. And now they're doing it with you. Now let's make this a little more, Mr. Klein. So let's say you are very successful and you're really healthy and you actually spend, what do you want? 30 years in retirement? So let's take this 15,253, 15,253 times 30 years. That's almost $500,000 in taxes. Think about that. So you have $1 million in your account and you're taking out 10%, which is 100,000. Obviously you're gonna go with the next 30 years, but the IRS is gonna take about $500,000 from your account. And I forgot to mention one more thing. Are you gonna be collecting Social Security? And they go like, yeah. Is that taxable or non-taxable? And they're like, I don't know. Well, it's taxable. If you make more than $24,000 a year as a single individual, 80% of whatever you get on Social Security becomes subject to income taxes. So your taxable income, according to this form, is $87,000. Let's say you're collecting $30,000 a year on Social Security. Does that make it taxable? They're going like, yeah. So now you're gonna have to pay income tax on the $30,000 that you're getting from there, which is funny because you also pay income tax when you earn that money as you pay your FICA. So is that double taxation? And they go like, what? Well, yeah, you pay tax indirectly, to be fair, but you pay tax when the money went in, and now you're paying tax when the money came out. And the only reason why is because you happen to be a good citizen who actually save money for retirement. How does that make you feel? Well, that blows, man. Well, that's the reason why we got to do some planning. So when can we get together and look at your situation and see how we can prevent this from happening? And that's it. That's your close.
Boom.
Questions on this? Something that is not clear about this form or this graphic. Good.
Straightforward.
Yep.
It's straightforward. So if it's easy for you guys to understand, it should be really easy for the client to understand. Sometimes they have little questions here and there. For the most part, most people will understand where are you going with this. Now, you guys know my style. I'm not a hard closer. I don't like to get on top of people and try to close them. I'm very, push-pull, very nonchalant. So that's what I say. I'm not saying that you should or should not do anything. I don't know anything. I don't know that right now. But what I can suggest, if you're open to it, is why don't we get together, look at what you're doing, look at your situation, and then I can give you a much better answer as to what makes sense for you. This is just in general, this is the way it works, but we can sit down and analyze how you can take advantage of these or not if it doesn't make sense for you. Would that be okay with you? And then that's when they go like, okay. And then you book your appointment and then you keep going. Okay? So you can marry the tax now or never, pencil presentation, napkin presentation, and then use this to close, use the graph to close, use this guide. And either you can email to them if you're doing a Zoom presentation, or you can hand it over if you're in front of them. The ones that I have here is old. So this is pre-2018, but I can order some of the new ones printed. And it's very nice paper, obviously, high quality market material. You can get a bunch and you can hand it over. But again, right now you're probably just gonna email it, and everything that you discuss is somewhat explained in the material, okay? All right, so that's as far as tax now, tax letter, tax number. So when I do the PowerPoint, I'm gonna include a lot of these points, and then I'm probably gonna use these as a base, plus some other points that I like to make, that I grab from other sources and put it in the presentation. All right. So your homework is going to be to memorize the presentation so you can present to the group. That's going to be your homework for next week. Sometime next week, I'm going to ask you to, okay, give us the tax now, learn, never talk. And we're going to practice our talk, because the better you become at it, the easier it's going to be for you guys when you're talking with clients. Or you can take a very small element of this and then talk to clients about that.
When are we doing those presentations, did you say?
Sometime next week, probably late next week, to give you guys time to practice this and go through it. Obviously, I'm not expecting it to be perfect, but I want you guys to get started in that process, because eventually you're going to be doing this on your own. And when I'm not around or whatever, you want to be able, right now I'm doing everything with you, but I mean, eventually you want to be able to do that. Okay. All right. There is another thing that I use, or that I used to use actually. I think Kim didn't get the email from Bob. Okay. I'll resend that for everybody. So there's another one. I think Bob put it in the package. That's an old presentation that I learned from what was his name? Old school producer, Band something. He was big into IUL. It was kind of the first year or two in the business when I learned this. So see if I do it right. Actually, let me pull it up from Bob's thing, because I don't want to do it wrong. I haven't used it in years because I've been using that box that I just showed you. But this one also gets the point across. So either way, it will work. Either one you use will work. If you are more into the napkin presentation, kind of sitting down with them, kneecap to kneecap, as they say, and do it that way, you can. Or you have an iPad like me, you want to do it like this, that's fine too. Doesn't matter. Either way works. But I found a lot of success using the Ohio National material, and it's easy because then I can print it and I can send it. This one, I wouldn't recommend you to send it to the client. You just want them to see it. All right, so let's talk about the benefit of the 401k. Now, sometimes when I use this presentation, it's like a part two or tax now, later never. is for the kind of client that says to me, well, Bianco, this is great, but it's a little misleading because when I get that tax deduction, I'm saving money in taxes. So you actually need to include those tax savings into the conversation if we're going to show an apples to apples conversation. This is going to be your engineer, your accountants, anybody with a background in finance. They are the ones who are going to bring that up to you. And that will be correct, by the way, because as your income goes down, that means you're earning more. So those savings, those taxes that you're not paying in that year, they should be counted. Now, the reason why I almost never bring that up is because they're not relevant. The number is so small, it's a non-issue for me, but they don't know that. So usually when they challenge me with that, I say, you know what, you are correct. Because as you do your taxes, your income goes up a little bit. But those dollars you're not paying in taxes, yeah, that is savings, no question about that. So let's talk about it. So let's say, well, let me change this to black. That blue is kind of weird. So let's say that you're putting $250 a month in your retirement plan, your 401k, right? I'm like, okay. Now let's say we do this every month. So that's 12 months. That means that we're putting $3,000 a year away in that 401k plan, right? Yes, okay. Now let's say that you are in a 30% effective tax bracket, just for the sake of round number. How much is 3 times 3?
No.
Right? That means that $900, that's what you're saving from taxes, right? This is your tax savings. Because you're not paying those $900 in taxes as otherwise you will have to pay if you were not putting the $3,000 in the 401k plan. That's the whole point of the deduction. It's not a tax credit. It's not a one-to-one situation. You're not saving $3,000 in taxes. It's a tax deduction. You're saving a percentage of whatever you're putting it away. So your tax bracket is 30%. Your effective tax rate is 30%. That's $900. Good? And they go, yes. Okay, awesome. So now let's assume that you're going to be working for 30 years. Right? So, and those are annual numbers. So how much is 3 times 9?
27.
Yeah.
Thank you. Glad to see you guys paying attention.
Yeah.
So you're putting away you're saving $20,000 in taxes over your lifetime, over your working lifetime, that is. That's kind of cool, right? They're like, yeah, and that money that you put in the 401k, gross tax deferred, is all good. So now we're gonna have $3,000 a year. And let's say for simplicity's sake that Dave Ramsey is okay. Because in Dave Ramsey's world, if they know who that is, but you don't have to bring that up. I bring it up to you because you know who that is. Because in his world, the markets always go out 12% a year and there's never negative years, right? It's like Bernie Madoff. Every year you make money no matter what. So let's say that's the world we live in. Every year, your account makes 12%. Do you know how much money you're gonna have? And that's a joke. Like, don't worry about it. We're not gonna make that. It's about 880,000. Is it okay we call it 900,000? And they go, sure. All right. So that means you're gonna take $900,000 out. I'm sorry. You're gonna have $900,000 in your account when you retire. So now you're 65 and you're ready to retire. Okay. Very important question you want to ask the client. Mr. Client, what percentage do you think you can take from that $900,000 to live so you don't run out of money? Or how much would you like to take out? The clients are going to say 5%, 10%, 20%. They're going to give you a number, right? It doesn't matter what they say. The reason why you ask them is to get them to participate with you, right? So they are paying attention and they see kind of where you're going. Let's say the client says, well, 7%. You know what? I'm going to give you a little more. It's going to take 10%. Is that okay? Sure. All right. So we're going to take $90,000. Fair? So yeah. Now, last point here. Let's say that I'm wrong. Like I'm completely wrong and taxes don't go anywhere. They don't go up. They don't go down, they stay the same. That means that you're still in an effective 30% tax bracket. And they say, yeah, okay. So how much is 3 times 9?
27.
7.
Right. So what's my point here? Do you see how in your first year of retirement, you actually gave back every single dollar you saved from the previous 30 years? And that's when they go like, what? Yep. So in your first year of retirement, you actually gave the IRS back all the money they gave you over the previous 30 years. How does that make you feel? Well, that doesn't make sense. Well, it gets even worse. Let's say that you also spend 30 years in retirement. So you die at age 95. So how much is 30 times 27? And they go, I don't know. So usually what I do is I hand them the calculator. If I have my phone with me, I say, do me a favor, 27,000 times 30. That is by design, guys. You want them to do that because you want them to actually feel the weight of the number. And the only way that you can do that is if they actually do it themselves. So they cannot say that you play with the math. They did it, they got to that conclusion themselves. So I take $27,000 times 30. That gives a grand total of $810,000. So, Mr. Klein, do you see how you paid in taxes almost the full amount of your account of retirement? And you say, yeah, that is by design. Does that sound like, what would be the word for that? When something just randomly happens? Coincidence. Does that sound like a coincidence? Yeah. And you guys, I'm sure you guys have watched the Tom Love video I sent you. If you haven't watched Tom Love, you want to watch it because he goes into way more detail on this than I am right now. But it's not by default. It's not a coincidence. It's by design. That is the way it's supposed to work because they want their money back. It can only be that way.
I have a question, Yanko.
Go ahead.
So you said they were retiring at 65 and they die at 90, but then you did it by 30. Was that what you meant? I'm a little confused by that 30.
All right, 95.
Okay. So that 30 is how many years you live after you retire.
Yeah, so we're gonna put here years in retirement.
Got it. Okay.
Right? So as you can see, I'm keeping threes and nines. I'm keeping that logic, right? And the reason why I keep it simple, round numbers, is because you guys are gonna have to memorize the number. I don't need a calculator for this because I know what the numbers are. If I start making very complicated numbers, then I'm gonna get lost myself in the presentation. It doesn't look good. So you wanna make it very simple, basic numbers. You memorize the numbers, you know where you're going, so you can focus on managing the client's reaction to what you're saying. And you can see and pay attention to their reaction. So here's my close. This is what I will tell the client. So Mr. Client, if I can show you a way to get you to have the same $1 million or more, but put this extra 800,000 back in your pocket, if I can show you how to do that, if I could do that, will that be of interest to you? And let them answer. Because if they say no, then we have nothing to talk about. But the question is so obvious that they should go like, yeah, oh yeah, I would like to get that money back in my pocket. All right, so maybe we should talk about what to do. So why don't we get together next week and we talk about it? So when you're doing your intro presentation, you're trying to get their attention and get their interest. Make sure that when they say, yes, I would like to know, I'm really interested, you don't go with, okay, so let me show the life insurance concept. Sometimes it's better to say, okay, well, let me come back and then we'll talk about it. I want to let them marinate the idea. Is the famous takeaway, right? Because odds are they're not going to buy right there. This is different from, as you know, from other kinds of sales. Nathan was doing solar sales. Well, yeah, that's a tangible, logical, straightforward sale. I'm buying a bunch of panels that go on my roof. I'm going to make this money, end of conversation, right? This is harder because it's a much longer process. And if you want to do it correctly, there's a lot of planning involved. So I need more time, right? So I don't want to do it right there because if I already covered 25 minutes on this, I'm going to need another 30 to just do a quick plan. I don't have time. So you're better to say, okay, well, I can come back and show you how that works when it's a good time for you. Trust me, people love what they can have. They just do. So that's a good technique. Not only you come across as more professional, but actually you let them. It's almost like in the TV shows, right? To be continued. you want that? How they call it? Hangers? Is that how they call them?
Yeah. Cliffhanger?
Cliffhanger, exactly. Cliffhanger, right? You want that cliffhanger in there so you can come back and now show the solution. Give me 1 second. Let me open my door. My guys are done. And it was getting kind of hot, so. All right. Questions on this?
No.
Fairly easy, fairly straightforward? All right. Well, when it comes to retirement plans, tax now, later, never, these are the two that I always use. These, the graphic, and the tax now, later, never. That's really what I do. Now, go ahead.
Oh, I was going to say, as a new rep who's going to be primarily focused on life, so this will be the majority of our presentations?
Not necessarily. There's about 10 concepts that we use for where you guys are right now. So you're going to have different places to go with this. It all depends on the age, what the client is looking for, what are you trying to promote, that kind of a thing. So this is just one. But I really would like you to learn no more than 5 presentations, just to keep it easy on you. Maybe even go down to two that you do that you're very good at it, that are just the first step. And then the planning step can take us in many other directions, right? So I guess you can say that you can use as a conversation opener. Right? Let's talk about, because that's going to be one of the most expensive things you'll ever pay. And that goes into my Circle of Wealth presentation that you guys have seen me do. Some of you haven't yet, but when I can do that next time because I want to focus on the tax today. But when I do my Circle of Wealth presentation, I'm making a point that over 35% or 40% of every single dollar you will ever earn is going to be lost in taxes. So think about that. Nathan, you're going to work for the next 40 years or more. And 40% of every single dollar will be spent on taxes. Yet, tell me, how much of the IRC code have you read?
How much of the what? I'm sorry, I couldn't understand the last part.
How much of the IRC code, the Internal Revenue Code, have you actually read?
None.
Do you have a copy in your house? No, right? And I know I'm being facetious, but I asked that to my client in a tongue-in-cheek kind of a way. Okay, so you're telling me that 40% of every single dollar you will ever earn is going to be paid in taxes, yet we have done no education about taxes work. Interesting. It's like me saying, I'm going to spend $1 million in a house, but I don't want to look at it. I don't care about how the house works. I don't care where it comes from. I don't care if the roof is okay. I'm just going to give you $1 million. Why would we do that? So you see, it's a conversation opener. If you haven't looked at the IRC code, how do you know the game? Those are the rules of the game. The money game, those are the rules right there. It's like Monopoly. All the rules are in the back of the box, right? In this case, the back of the box is the IRC code. Yet none of us, either in high school or in college, have been taught what's in that book. Why? Because they don't care if you make money. The educational system is designed to make you a worker, right? Because the educational system today was designed in the 19th century. And I'm not putting the education system down. I love school. You don't know me that well, Nathan, yet, but I'm an academic person. That's why I have my UCI logo back there, right? I'm all for school, but I have to recognize that the system was designed in the 19th century because at that point, during the Gilded Age, they needed workers. And as a worker, I need you to know how to read and write. I need you to know how to do math, but I don't need you to know how to think. because you're in the line, right? Like that Chaplin movie. Have you guys watched the movie where Chaplin is in the factory floor? If you haven't watched that, oh, you gotta watch it. Chaplin is one of the few people that is super old, but it's still really funny today. It's just, I think it's funny. What is the name of that movie? Metropolis, I think is the name of that movie.
I haven't seen that.
Chaplin.
It's old school.
That is really old school.
Right?
Talking about old school. Now I gotta look at the name. You can see it on YouTube for free. Those movies are free now. Chaplin in the Factory. What is the name of that movie? Don't ask
Probably
me.
like Working Man or something simple.
Modern Times.
Oh.
Oh, I have to show this. Give me 2 minutes.
Get your business insured in
share this.
10
This is
minutes or
really fun.
less with Next Insurance. It's super easy. Tell us what you do.
Are you guys here?
Yeah.
Yeah.
It's from the early 30s. That's the most famous scene right there. Well, I'll leave it there. So you guys want to watch it, you can watch it. It's
I
good.
gotta watch the rest.
It's a really funny one. And it was done here. So you go to Sunset and it's not Vine, it's the next one. Anyway, where the Muppets used to be, that used to be Chaplin Studios. That's where the movie was made.
Okay.
So you have some local history too on the process. But anyway, so the point is that that's what you were trained for. You were trained to be a worker, go to work 8 hours and stop thinking. Now we're in a different world. Now we're in a digital, whatever you want to call a society where you need critical thinking skills and you need different things they didn't have before. So a lot of these, financial talk was never taught to us in school. And I'm just giving you this to give you talking points. So when you are talking to that prospect in the meeting, in a networking event, you're having a conversation on LinkedIn, these are small things that can get people's attention, right? And one of the ones that I love to use, and you guys heard me talk about this, is about owning a home. I'm not convinced that owning a home in this new generation is the right thing to do. The American dream has shifted and has changed into what it means and what it's supposed to mean and how it's supposed to be applied. I'm not convinced that's the best way to go. And because grandpa bought a home and my mom bought a home, and you tell them now that you're not convinced that you should buy a home, now that creates a gut reaction. And they're gonna tell you you're wrong and that you're not, and that you're weird and that you shouldn't talk about that and blah, blah. Every time you challenge people's basic assumptions, you're gonna get a reaction. But in my case, that's a good thing because I don't want to do clickbait. That's a waste of time. But I want to give them things that make them think. And if they automatically turn around and say, no, you're wrong, perfect, let's talk about it. Now I'm engaging. See? And I know it's real. I know it makes sense. And I'm going to explain to them why. But I want to create that engagement. See? So that a lot of these things help us and work for us to be able to do that. All right. Good so far?
Yeah.
Another neighbor? All right. So I'm going to show you one more thing today. So I want to keep it simple and I want to keep it manageable. So did any of you guys, I know Nathan, you didn't get the invite probably, but did you guys attend the volatility buffer webinar? Did you guys watch that? You didn't have to do it, but I'm just asking if you did.
Did not.
No?
Oh.
Okay. You can go back and watch it whenever. It was this guy. He, I don't even know who he is. I think he's a producer with Ohio National. He was doing a presentation about, very similar to what we talked about how to use life insurance as part of your portfolio. Okay. So he did something like that. Let me just get the, so we have a piece that talks about that. So let me get the piece here. The number. Oh, I don't have it. Interesting. I don't have it. Okay, let me find it. He talks about sequence of returns and using that volatility buffer. Okay. So let me go to life products. No. Live marketing. Sales ideas. Nope. 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 Oh, where did that go? So I'm gonna go here to forms.
Are you supposed to be sharing something else on your screen right now? You're still on your whiteboard.
Yeah, well, I'm supposed to share. I just haven't found it yet.
Oh, okay.
I'm looking for it. I think it's diversification. Oh, that's terrible. I don't know where they put it. Here's one of my complaints about the website. Has way too much stuff. And when I need something, I can't find it. Okay, live marketing, whole life sales ideas. I really wanted to show you that. Okay, why don't we take a 2-minute break? Let me call the fast team and they'll tell me the form number. Because I really want to show you that today. It's gonna take me like 3 minutes to get the fast team on the phone.
Okay.
So you need to stretch for a minute or two. Let's do that. Oh, it's too late.
Thank you for calling the Ohio National. Welcome to our automated system. Information on the contract at any time. Or to speak with a representative, press 0. Experiencing a large variance in today's call volume, which may result in longer than normal hold times. Thank you for calling the Ohio National Sales Associate phone line. For automated access to account values on variable contracts or fixed annuities, press 1. For underwriting customer service, press 2. For product sales and marketing support, press 3. For life or disability, for the fax team, press 1. For disability, your call may be recorded for quality assurance purposes
you on recorder line.
Hello, Daniel. How are you? This is Janko Castro, 259-097.
What can I do for you?
I'm looking for, we used to have a marketing piece for life insurance about sequence of returns. I think it was about a teacher that was retiring, and I'm having a hard time finding it. Do you know the phone number of that form? I don't know if you've ever seen it.
Yeah, that's not anything that I've personally seen, and the reps that have more experience are gone for the weekend or gone for the evening, so I don't even have anybody to ask what that form looks like or if they still have that form.
So on the website, if I want to find all the life insurance marketing pieces, because I know it's there, I just don't know how to get to where all the marketing pieces for life insurance are. Do you know how to get there on the
Well,
website?
I mean, you can go to the forms catalog and see if you can locate it, but the issue with that is identifying words don't always generate anything. So unless you know the form number, then it's like trying to find a needle in a haystack.
Oh, okay, so I cannot go like by whole life or IUL, so it cannot be narrow like that. Is that what you're saying?
Correct. No.
Oh, well, that changes things. Okay. All right. Well, thank you for your help, though. I appreciate it.
Yeah, not a problem.
Take care. Bye-bye.
You too. Bye.
Well, that didn't work, did it? Retirement income. Oh, there you go. I found it. All right. We'll wait for Tina and we'll get going. I found it. Hey, Terrell, are you there? Okay, I guess Terrell is not there either. So how's your day going, Nathan? You had a busy morning?
Yeah, it's going well. Just trying to study and pick up things, and I know it's going to be a bit of a fire hose at the beginning. Just trying to take on everything I can. Had a good training this morning with Ben, and we did some role playing, and that went well. So, yeah.
One day at a time. One day at a time.
That's right.
You'll be fine.
I had a question before we get going. If not, everyone's not back.
Go ahead.
Ben said we would be starting calls tomorrow.
Mm-hmm.
Is that on your schedule as well, me and you?
I think it's you and him.
Okay.
Yeah.
That's what I thought too, but I thought he said me and you, but that makes more sense. And then with our first calls, so for tomorrow, I need to be ready to be able to hold full conversations about this, or I'm just strictly trying to set appointments tomorrow.
Yeah, if he hasn't showed you the scripts that we use, he'll probably will tomorrow. And the scripts are very simple. So it's not about product. It's nothing for sale. We don't want
Yeah.
we don't want to feel anything like that because, like I told you, that's not what we want. We just want to show him the information. So yes, you won't be expected to do a presentation over the phone because you're not ready yet. You'll be there in 3-4 months, but not yet. So he'll be the one doing the presentation, but we want to get you exposed to making those phone calls and having those clients conversations and all the emotions that go into it. And you experience that when you were doing your own sales, so you know.
I see. Okay.
Yeah. So, but the key here is that there's nothing for them to buy. There's nothing to sell. If they ask you, hey, so is it like a sales presentation? No, it's really a training presentation, trying to educate them about what you're doing. Because if you were to get any referrals, I need them to know what you do.
Mm-hmm.
Because everything we
Okay.
talked about right now in the last half an hour, they don't know.
Mm-hmm.
But if they do,
Got it.
now they have a better way to tell you, okay, go talk to this person.
Perfect.
It gets easier. You'll see.
Yeah.
Yeah, it's a little different than what you're used to, I'm sure, Nathan. It's kind of more of you're just getting conversations started rather than, booking a sales appointment where you're going to close it, on that
Mm-hmm.
same initial phone call. So that
Yeah.
was a little different for me as well. I'm still kind of figuring that out, but
Yeah, it's what sales coaches like to call the consultative approach, but I don't like to use that term because, again, since we do is way more encompassing than that.
Mm-hmm.
It's not a one-time transaction; it's an ongoing relationship building. It's a little bit different, and that's the reason why we don't want to alienate anybody. Because again, if you're my client and I'm doing your retirement, I'm going to talk to you for 20 years. So the last thing I want to do is to alienate you and make you feel weird.
Right.
If I do
Cool.
that, I might as well go home because it's not going to work.
Okay.
All right. So I found the piece. Boom. There you
Oh,
go.
you found it? Because I thought they can help you.
No, I found it. I'm better than the fast team.
Mhm.
Nice.
Better than the fast team. Well, sometimes when companies you are so. I never had a corporate job, so I don't know. But from what I've experienced, you have very narrow responsibilities. So if you are like in the chaplain, where you are the guy who turns the screw, that's all you do. If the other guy is doing something else, you don't know.
Right.
that's
Right.
not my job, right?
Not my job, right? So this is the marketing department is not part of the fast team, so they don't know where these things are. That's what I'm guessing it is, but that's okay. The fast team, they're good people. So I don't know if Bob talked about the 3-leg stool presentation, something else I'm going to show you, but this is the mini version of the 3-leg stool presentation, how people plan for retirement, okay? We'll get back to that because I don't want to talk about that right now. I want to talk to you about Catherine. So here is Catherine. This every time I use this is really fun because I can just try to put like a real person in the concept. I know sometimes it just feels weird. So I always make fun of it. Like, here's Catherine, and Catherine married Peter, and they were really happy together, So it's kind of interesting. But it's a good way to get the client, because the client won't remember save withdrawal rates. The client won't remember buffer strategies. They'll remember Catherine was a teacher.
Right.
If we don't remember facts, we remember emotions. That's what we remember. So Catherine is an attorney, sorry, not a teacher. She's 45, and then she's going to have a $1.5 million when she retires. So the idea here is that the way most people think about retirement is that when I retire, I'm just going to spend whatever my money earns. That way, I won't run out of money. Now, to some of you, I already show you the concept of safe withdrawal rates. That your safe withdrawal rate is significantly lower than the actual performance on the account. Why? Because of the volatility factor. The idea here is that if you're taking money from a portfolio, it's not about the returns. It's about the sequence in which you get those returns. That's what makes a difference. So the way most people think of their money is in the following way. So, okay, I have $1.5 million. If the market average is 5%, I get to withdraw 5%, right? And then it should be a wash. And that's what it shows you here. So she has $1.5 million. She takes 100,000, and then the average market is 5%. So that's the average rate of return. 5, 5, 5. You take 5 times 10 divided by 10. That's what you get. 5 plus 10 divided by 10, you get a 5, right? That's what it is. So if I start at 65 with 1.5 million, I spend 1 million over the following 10 years, and I still have 1.1 million in my account. Why? Because the account has been making 5% every year. Get that? Because 5% of 1.5 million is more than 100,000. A little less than 100,000. But this is not reality. That's the way people think this works, but this is not reality. This is reality. In this 10-year period, we're going to give Catherine 2 bad years, right? Negative 22, so 2 bad years out of the 10. Not bad odds. Now, the market's still going to average a little bit about 5% because you have negative numbers and positive numbers. But we went from having 1.12 million at the end to having only $767,000 in the account. Why? Because as I told you before, once you add a negative return into the equation, the average becomes meaningless from a dollar perspective. I don't care what the average is. What I care about is how much money I have. So the point here is that the same average market average, 5%, here I have 1.1 million, and with the same average, here I have 767,000. Now, the reason why I use this sometimes is because here I have the numbers. I can explain this conceptually, and for the client, that may make sense, but when you put it in numbers, it has a much bigger impact, I think, than when
Can you send us this, by the way?
Yeah, I'm going to send you both. I'll send you both at the end. Yeah, I'll send that at the end because I don't have Nathan on my list. These and the one about the tax now, later, never. So you can also do it this way. I love doing these little mini presentations. You guys, I know I like doing these because they're easy, they're quick, easy to memorize, and it gets my point across, right? So when I say averages don't matter, I'll tell my client, okay, you're gonna give me $1,000 to invest for you, right? So let's say the first year, I made 100% on your money, right? So how much money do I have? 1,000, right? But the next year I got distracted with something, so we lost 50%. So how much do we have?
1,000.
Back to 1,000. But then I didn't want you to fire me, so I had to get working. I double your money again, so we were back to 2,000, right? But unfortunately, we had an obstacle on the road. I lost again 50% again on your money, so we're back to 1,000. Mr. Klein, what was your average rate of return? And the client usually is gonna say, well, 0. No, it's 100 minus 50 is 50, plus 100 is 150, minus 50 is 100. Divided by the 4 years we invested together is 25%. But how much money did you make? 0. Kind of crazy. So when you look at a mutual fund, prospectus, and they show you the average rate of return is useless. Well, I don't want to say useless, but it's meaningless, right? Because I don't care what this is. What I care about is this. And this is the mini napkin version of what I'm showing you over here.
All right.
With the same rate of return, average rate of return, I actually have less money. How is that possible? Because of the sequence and the negative years. That is a problem. The negative number changes the game. So very important the client understands that. And usually most people get blown away when they see it the first time because they don't understand how that works, right? So I don't care about the average. What I care is about the actual return. That's what I care about. Which in this case, it will be negative. So the concept behind having a buffer or a volatility buffer is that instead of making withdrawals, the problem of making a withdrawal in a negative year is that you're locking in your losses. You have to sell the share of the stock, the share of the fund when you're in a negative market. So you're locking in that potential loss. So the idea of having a buffer here is that when you have a negative year, you take the money from somebody else, from somewhere else. You're hedging, if I can be fancy about it, you're hedging the volatility risk with a different kind of account. And that's when the life insurance can become handy. That's the place when you can do that. Because if I can buffer and not have to sell my asset to draw income, I can wait for the market to recover. And in this case, it went back to 28%. So instead of selling that, spending it, and losing that upside, I can leave it alone and I can get the upside. And then take the money out in positive years. We hit a negative 37. Then I don't pull money from here, and I can wait to recover, which it did with a 26% positive. You see? So now, after everything's said and done, instead of having $700,000, I have almost 1.1 million. Almost the same number that I had over here. I'm sure 40 grand. It's kind of cool, right? In negative years, take the money from your buffer or from your hedging account. In positive years, yeah, let's sell some winners. And that's gonna preserve the account for much longer. So when we talk about safe withdrawal rates, and you guys gonna watch this in the Tom Heckner video, we're talking about 2-3% at the most, right? But if you add the buffer, we can go to 7, 8, 9, even 10% withdrawal rates without risking the account running out of money. That's how you can do that kind of withdrawal rate without risking your client's account. So if I'm talking to that 50-year-old, 60-year-old, and say, well, what kind of value can I bring to that person? I think this will be a fantastic concept to bring out to them. How are you hedging against the volatility, or how are you hedging against taxes, which could be another one. Because think about that. If I'm taking 100,000 from my qualified account, I'm not spending 100,000 because I gotta pay the tax. But what about if I can take 100,000 and then withdraw the difference from a different account that doesn't create a tax problem? So I actually get to spend the 100,000 that I want to spend. And in doing so, reducing my risk, because if I wanted to spend 100,000 just with my qualified plan, I will have to take a much larger number, a much larger withdrawal. Therefore, exhausting the account much faster.
A qualified account, is that just 401k or IRA?
401k, IRA, exactly. Any tax deferred kind of account, yeah.
Mm.
You guys see that? So by creating that buffer, creating that hedge, you can actually reduce risk, increase cash flow, and potentially even reduce taxes if you do it right. So I guess what I'm saying with this is the ultimate goal of a good financial plan is to reduce your liabilities, reduce your risk, and maximize your lifestyle and how much money you get to spend. That's the whole point. Okay? And then it kind of gives you a summary of, why life insurance is great. And, like a summary of what we talked about before. So now this goes into an illustration. Okay, so she's 45, in very good health. We're going to use a Prestige 100, and she buys $1 million. She's putting $16,000 a year. So this will be like a scenario like with Terrell's clients, where we're saying, okay, the next 10 years or next 15 years, stop funding your 401k plan. Let's fund that buffer. Let's build this bucket over here so we can, use this strategy, reduce your liability, reduce your risk, and actually increase your income. So this will be something like for her. So she's going to do it for a little longer, I think. She's going to do it I guess all the way to age 100 in this scenario. And then this is showing you the withdrawal. This is old, so I wouldn't rely on this. We can run our own illustration, but it gives you a summary of the benefits stuff so that you can leave with your client behind. And then it has a copy of an illustration, but this is old. Well, actually, I'll take that back. They put a new product in there. Okay. 3/1/2019. Okay. I guess we can take a look at this one. Okay, so she funded it since age 45, and then she retires here, and then she took these 2 loans out. Now they kept putting premiums in it. I wouldn't. I will have zeros here. But anyway, you get the concept. You've seen this before. So she's taking the 100,000 here and the $100,000 there. And if she needs more money, she has about 1.5 million over here as well that she can use. And a fair life benefit, which is kind of cool too, because if we go to life expectancy, age 85, she has a $1.7 death benefit, which completely replenishes the 401k or the IRA account when she retired. You know, so you're replacing that and passing all the money to the next generation on a tax-free basis, which I think is pretty cool. All right. Cool. Questions on these guys?
Negative.
Do we have access to these forms online at this point, or is it after we're contract?
So I'm gonna send you the marketing piece right now, but you can do your own illustrations once you get your license. We kind of put the program on your computer and show you how to use it. So you'll get
That's
there.
what I figured. Cool.
And so you'll get there. Terrell, Tina, and Kim. This is the Ohio National. What is it called? Managed retirement income. Okay. There we go. Yeah, I think it's a good piece. And the other one, I forgot the phone number. Hold on. $24.10. All right, so let me send this to you guys. This is a new one, which is kind of nice. So you have the updated tax numbers. Well, Nathan and Tina. And this is diversify your income. Tax now, later, never. All right, so it sounds like you guys are getting it. So it's fairly simple. Especially you guys have been exposed for over a month to this. We're talking about this in different ways. So you guys are getting it. Or you got it, which is great. So
Yeah.
that makes everything easier. So I think where we are right now, especially for you, Terrell and Tina, we are really on that presentation area, trying to get you to feel comfortable doing a lot of these talks with your clients more comfortably. So I think what we can do, like I said, is I'll put this on YouTube. You can watch it, you can practice it. I'm gonna try to script it and get a presentation going to save you time. But I would like to practice that with you guys next week, with all of you guys next week. Tomorrow, I won't be able to have the 1 p.m. I have a bunch of client stuff in the afternoon, but we will meet for sure for our 3 p.m. We will meet for sure. And I guess that's it for today. But you guys have any questions, comments, anything else you guys want to talk about before what we discussed today, besides what we discussed today?
No.
No?
You say we're meeting at 3 tomorrow?
Yeah, so we have our accountability meeting at 3 tomorrow. So
Okay.
that will be our only meeting. But we won't have class tomorrow because I have a bunch of client stuff in the afternoon that got there. I couldn't move it.
Okay.
We'll pick up the training on Monday. We'll continue working on Monday.
So the 3 o'clock accountability, is that weekly on Fridays
Mhm.
at 3? Okay, cool.
Every week at 3. Zoom, same place, same channel.
Sweet.
Let's see. Can you? I mean, they don't have to stay on. Can you just look through this illustration with me and tell me if there's anything I'm not catching on it? I got this other illustration that ran for my mother. You mind looking
Sure.
through with me? Okay.
Yeah, you guys can stay for this if you want to see it, or pretty much we're done for today unless you, Tina, and Nathan have any other questions.
No, I don't think so.
No? All right, well, get on your calls, Tina. Keep on working on your list. If I know you have clients to reach out to, I think
Yeah.
it's time to do that. So let me know if I can help.
Okay, great. Thanks,
All
guys.
right. All right,
See you
Nathan.
tomorrow.
You guys take care.
You too.
All right.
All right, Carol. Let's work on that. I have something for you too, anyway. So
You mind if I hang around and just observe?
no.
Cool.
Yeah, when you let me share the screen, I'll show it to you.
Okay, so let me